Asset life. The estimated length of time an asset is expected to be useful. Typically, an asset life will be represented in years, although it can take other forms such as units of production, a measurement of machine output, for example. Under the units of depreciation method, useful life would be estimated by machine output, such as quantity or hours. A good example might be a laser eye surgery machine, in which case every single zap of the eye is recorded on the machine and paid for by a license. This highly sensitive piece of machinery might be subject to 1,000 procedure limit until it locks the doctors out from using it. So asset life. Asset life under GAAP may be different from asset life under tax for the IRS. The asset life in general, from a conceptual basis, is an estimate how long is this thing going to last. So let's take a computer. Consider a computer. A computer is a fixed asset. Fixed asset. And let's say this computer costs $3,000. Or heck, let's say $5,000. Let's pretend it's the 90s. $5,000. Now, we know that computers are an asset, so we don't just expense this on the profit and loss. Rather, it should be deducted year after year, judging on the expected useful life. Now, one opinion, quite possibly by the IRS or other governmental figures, is that a computer will last 5 years. Now, the last time a computer lasted me 5 years, maybe college, I barely remember. In this case, let's just say, for argument's sake, heck, the computer is 5 years. And let's also say that the depreciation methodology, how the asset is written off over time, is straight line. So it's just going to be consistent, 1 year after the other, the same. We'll assume that salvage value, the value at the end of the computer life, is nothing. Let's say we're going to use this computer for 5 years and then chuck it. So every year, the expense will be $1,000 in the form of depreciation. Based upon this life of 5 years. Now there's other depreciation methods. This is straight line. There's also modified accelerated method, MAKERS, which is more of an exponential or highly rapidly increasing depreciation over time, because they figure in the earlier years that more expense should be taken. If this was a machine, let's say it was a machine here, and it's based on 5,000 hours. Machine's good for 5,000 hours. It costs $5,000. So after year 1, we say, oh, it was operated 700 hours. Therefore, 1 hour is $1. We depreciate. We have a depreciation expense for 700, adding also to accumulated depreciation. And the net asset value after that year 1 would be 4,300. So, this is the example of a computer. You might also have things such as intangible assets, which are amortizable, and the IRS may say, hey, there's a 15-year life on that, or whatever it happens to be. So an asset can be anywhere from 1 year to 15 years plus plus. Now land has no life. Infinity. Land does not get depreciated. It does not get amortized. So land is forever in accounting. So land, no life. Land is forever. Other assets might be 1 year to 15 years. And for tax purposes, tax people like to depreciate. Sometimes they can do the whole thing for rules. Under GAAP, it might be a little bit more conservative, a little bit different methodologies, but the point is, tangible things only last so long, and what we don't do in accounting is say we buy a building for $1 million. This is not an expense in 1 year. You have a land portion, which might be $300K, a building, which might be $700K, and this would not be subject to any life, the land, and then the building might be a 30 to even 50-year type of asset, and that's the life, and that is going to determine the annual depreciation costs in terms of a normal, regular fixed asset, and for an amortizable asset, an intangible, like a patent or goodwill, then it will be the life of the amortizable asset. This has been accountingplay.com. Thank you.